This is question number 1 of practice homework 4 for chapter 8. Creole restaurant is considering the purchase of a 9,200 souffle maker. The souffle maker has a economic life of 5 years and will be fully depreciated by the straight line method. The machine will produce 1,600 souffles per year, with each costing $2.40 to make and priced at $4.85. So from this sentence, we can calculate the revenue per year and the cost per year. It's simply the number of products times the price, that's the revenue, and the number of products times the cost, that's the cost. And we should also consider the depreciation given the initial capital expenditure of this equipment. Assume that the discount rate is 10% and the tax rate is 40%. What is the NPV of this project? And rounding requirement, that's very important. Do not round intermediate calculations and round your answer to 2 decimal places. So this example, this question, you can use many tools to help you to solve. For example, you can use just a very simple calculator. You can do it. You can also use a financial calculator, or you can choose to use Excel. Here, I choose to use Excel. One of the advantages of using Excel is that it can help us to automatically meet this rounding requirement of not rounding intermediate calculations. And also, it's very convenient to change the number of decimal places for the final answer. So this is a very, actually, it's not a very straightforward question about NPV calculation. So we have multiple years. We have year 1, year 2, year 3, and year 4. I guess we have 5 years. Yeah, we have 5 years. Year 5. Now this is year 0. Year 0, we have this is the equipment cost. Equipment cost, we incurred this cost at year 0. The cost is 9,200. 9,200. So we should know this is cost. So later on, we need to deduct this rather than add it. Here I just keep this as a positive because later on I want to use this number to calculate annual depreciation. So that's what the first sentence tells us, and we skip the second one until a later time. And the third one, as we said, from this one we can get the revenue. Revenue is simply actually, why don't I write more steps? I can write this insert. So I can write this units. Unit is every year. It's the same, so it's 1,600. I can just pull this all the way to the right. Every year it's the same. Price is also the same. It's the same. It's $4.85. 4.85. Again, I can pull this all the way to the right. And why don't I also insert one more row? This is the cost. So cost is the $2.40, and pull this all the way to the right. So now I can calculate revenue. Revenue is simply the number of units for a specific year times the price, and pull this. That's another advantage of using Excel. You can do 1 year's calculation and pull the mouse, then all other years will be calculated automatically. The revenue and then cost. To differentiate from this cost, this is the cost per unit. Price, I don't think I need to write it because generally we understand price to be the price per unit. So this is the total cost, and it's the number of units times the cost per unit. So again, pull this all the way to the right. And then I can calculate the depreciation. The depreciation is simply the in order to calculate depreciation, let me rename this. Right now it's only B2, so let me rename this as a EQUP, equip cost. So you'll see why I want to do that. Now I can to calculate the depreciation, because the second sentence tells us the machine will be fully depreciated by the straight line method over 5 years. So every year it's going to be 1/5 of the initial equipment cost. So now if I click this, you see here it's equip cost. If I don't use a variable name for this cell, then it's just a B2. And then later on, if I want to pull this all the way to the right, then the next year, year 2, will be C2 times 1 over 5. And year 3 will be D2 times 1 over 5. So because these cells are empty, so this will generate an error message. That's why I want to use this. I want to rename this to be a specific variable name. Hence, you see every year this will be kept the same, equip cost. So that's the annual depreciation. So now from that, I can calculate EBIT, earnings before interest and taxes, which is simply the revenue minus cost minus depreciation. And do this for every year. So do we have any actually for this, I don't think we need to consider the interest payment. Here we don't have any interest payment either. So the next one will be taxes, right? Taxes. Taxes is simply the tax rate. Let me insert one more row, the tax rate. Tax rate is 35, 40%. So again, let me use the name T rate, tax rate, to stand for this 40%. So taxes will be based on EBIT and times this T rate. And pull this all the way to the right. So now I can calculate net income. Net income is simply EBIT minus taxes, and pull all the way to the right. So now I can calculate operating cash flow. Generally speaking, it's EBIT. We start from EBIT, and then we add back the depreciation, and then we deduct the taxes. And we can do that here. Actually, why don't we do that? It's better. So we start from EBIT, and then we add back the depreciation, and then we subtract the taxes. That's my operating cash flow. And sometimes we need to do some adjustments. For example, if we have the net working capital information, we can do that adjustment. Or we can, we also need to consider the capital expenditure. In this case, the capital expenditure is only incurred in the current year, year zero. So operating cash flow, it's just the final cash flow. So the NPV will be based on this this free cash flow, which is simply the operating cash flow, the current year minus the equipment cost. Actually, here I don't want to keep the equipment cost because I want this every year to change. If I keep this variable name here, then when I pull this all the way to the right, this won't change. But for the subsequent years, it should be the OCF minus the corresponding cash flow, which is empty, which should be 0. So I want to change this back to B2, yeah, and then pull all the way to the right. And so you see all the other OCF will not be affected. So now I can discount rate. Discount rate is 10%. So NPV will be based on, we can use the NPV function. NPV function equals NPV open parentheses. The first argument is simply the discount rate. And starting from the second argument, it's the cash flows, all the future years' cash flows. One thing I want to emphasize is that the NPV function doesn't take into consideration of the current cash flow. So that means once we input all the subsequent future cash flows from year 1 to year 5, still need to add the current cash flow. Why do I add? Because I have already taken care of the sign on the cash flow. So that's why I have to add rather than subtract. So, and you can see that this also automatically meets the, sometimes if you don't keep, if this is not 2 decimal place, you can just format cells and change the number to keep 2 decimal places to be consistent with the rounding requirement. And also using Excel has the advantage of automatically meets the rounding requirement of not rounding the intermediate calculations, because so far I don't think we have done anything to round the intermediate calculations. So this number should be the final answer. So I can just copy this back. I may need to get rid of the dollar sign. I think I can keep the comma. That's acceptable by Connect. So since NPV is positive, so we should make the purchase, right? So that should be the final answer. So now let me check my work. Okay, good job.